the on again, off again feeling to this market, but at the moment, it really does feel like a dire sentiment out there. Do you agree?
Oh, I think it's certainly dire sentiment, and I think if, I think the first rule of investing that we were all taught is that when everything looks so dire, it may be time to start looking around to buy in. But the second rule of investing is don't catch a falling knife, and it seems like there are a lot of falling knives out there still. Whether it's in the US or Europe or even some of the news out of China, the economies are still slowing around the world and central banks are still hiking. And until we can see our way through, at least in the US, when that hiking is going to stop, it feels like the market isn't going to go too much higher from here.
You talked about the markets not wanting to catch a falling knife. What are sort of the signals that you're looking for to be able to get more comfortable and confident getting back in these markets?
I think some of the signals your colleague mentioned earlier about breadth of the market sell-off, some of the more technical factors that have been driving the markets, and some people sort of nibbling at the bottom. The biggest fundamental question, though, of course, is when is the Fed going to stop hiking rates? And the market, I think, has been caught back-footed a couple of times already this year when it seemed like inflation was peaking, and then it surged a little more, and rate expectations were driven a little bit higher. What I think we're seeing right now is, again, some signs the economy really might just be slowing. And so we might be able to see through to rates topping out at 4.25%, 4.5% next year. And that's when I think markets are going to be able to start readjusting, understanding where long-term yields are. You've been talking a lot on this program about valuations. It's really hard, though, to compare those valuations in an era when rates were 2% versus what they may be, 2 or 3% going forward.